Hello, dear friends. My name is John A.G. Today I want to begin with a warning, not because I want you nervous and not because I'm selling drama, but because silver is trading in a regime where normal intuition breaks. This is not a calm commodity tape. This is silver behaving like a leveraged instrument. Fast swings, sharp reversals, thin moments where the market feels like it's moving through air. And in that environment, a headline like "Warning, Silver targeting $88 tomorrow, turnaround Tuesday" can either be serious analysis or cheap theater. So I'm going to do this the professional way. I'm going to make the claim conditional, define what would have to happen for the number to even matter, show you how to identify the real flow transition people call turnaround Tuesday, and give you a simple dashboard to watch so you're not guessing, not chasing, and not getting emotionally hijacked by a big round target. First, let me put the most important sentence in the entire video right up front. $88 tomorrow is only relevant if specific conditions appear. Reclaim and hold, momentum expansion, and macro headwinds neutral. If those conditions do not appear, ignore the number. It's just a headline. That one line protects you from 90% of bad content because the market doesn't care about your target. The market cares about flow. It cares about positioning. It cares about liquidity. It cares about risk constraints. And when those constraints collide, price can move further and faster than casual observers think is reasonable. Now here's the roadmap. 3 things. 1, why a number like $88 can even enter the conversation as a next session target in silver. What engines would have to light up for that kind of acceleration to be plausible. 2, what turnaround Tuesday actually means, why it's not a rule, not a superstition, but a flow transition that sometimes happens after early week liquidation. And I'm going to add a safety line. Tuesday is not guaranteed. If the flow doesn't flip, Tuesday can be continuation too. 3, the pro dashboard. 3 screens, 3 confirmations, 1 falsification test. Plus how to define a key level without drawing 100 lines, and how to think about dealer hedging without needing options data. And 1 more clean trust line before we get into it. This is educational analysis, not financial advice. Your risk, your decisions. All right, let's begin with the core idea that explains most violent market moves. Big moves are rarely about new information. Big moves are about old positioning meeting new constraints. In other words, markets can look stable even while fragility builds under the surface. Crowded trades, leverage, tight stops, thin liquidity, then one push, sometimes small, triggers a cascade. People love to argue about the last headline because it feels concrete, but in stress regimes, the headline is often less important than the structure. The structure determines whether a move becomes a normal day or a stampede. Silver is especially good at producing stampedes because it sits at a crossroads. It's traded as a metal, treated as a hedge, used as an industrial input, and speculated on like a high beta instrument. That mix attracts multiple crowds, and when multiple crowds try to exit or enter at the same time, the tape can move violently. So when someone says $88 tomorrow, don't believe it and don't laugh at it. Translate it. The real meaning is the market structurally wired for an upside acceleration if flow flips? That's the only adult version of the claim. Now, what are the engines that can create a one-session acceleration in silver? There are 2 primary engines and 1 amplifier. Engine 1 is short covering. Engine 2 is dealer hedging cascades. The amplifier is stop-driven momentum flow. If those show up together, a move that looks absurd on paper can happen quickly, especially if liquidity is thin at the wrong moment. Let's break them down in plain language. Short covering first. A short is a bet that price goes down. In calm conditions, shorts can manage risk. In stress conditions, shorts become fragile because volatility increases margin demands, and risk managers tighten exposure. If price rises through levels that matter, shorts are forced to buy back to exit. That buying pushes price higher, which forces more shorts to cover. That feedback is a squeeze. The key word is forced. A squeeze is not a mood shift, it's obligation. Now, dealer hedging cascades. This is where people assume it's too technical. It isn't. The simple version is, options positioning can create mechanical hedging flows. When price breaks out, dealers often have to adjust hedges. In certain zones, rising price can force additional buying. That buying can accelerate a breakout. Here's the limiter so you don't get lost. You do not need to watch options data. If price accelerates on a breakout and pullbacks stay shallow, it's often a sign that short covering and hedging flows are active. That's it. You're watching behavior, not spreadsheets. Now the amplifier, stops and momentum. Modern markets are full of conditional orders and systematic strategies. Breakouts trigger buys, stops trigger exits. Algorithms detect speed and join. People waiting for confirmation jump in. This adds fuel. In a thin market, fuel becomes acceleration. So yes, a big number like $88 can be tested quickly if the market flips into a regime where buying is forced and liquidity is thin. But now we must make this practical and conditional. When does that flip happen? This is where Turnaround Tuesday comes in, and I want to clean up what that phrase actually means. Turnaround Tuesday is not a rule. It's not a calendar magic trick. It's a label some traders use for a flow transition that sometimes appears after early week liquidation. And here is the safety line you asked for, stated cleanly: Tuesday is not guaranteed. If the flow does not flip, Tuesday can be continuation too. So what is the flow transition? It's the move from forced selling to forced buying. It's when the market stops rewarding shorts and starts pressuring them. It's when early weakness fails, the tape reclaims levels with urgency, and the crowd leaning the wrong way is forced to run to the same door. To understand that transition, you have to understand liquidation. There is normal selling and liquidation selling. Normal selling is choice. Someone decides to reduce exposure. Liquidity absorbs it. Liquidation is obligation. Someone is forced to sell to raise cash, meet margin, comply with risk limits, or survive volatility. In liquidation, people sell what they can, not what they want. They prioritize liquidity over price. That's why liquidation can feel like the world ended even when fundamentals didn't change much. The system is clearing leverage. Now, the most important fact about liquidation is that it ends. It ends when the forced sellers are exhausted. And when liquidation ends, the market's character changes. Here's what character change looks like in real time without romance. Price stops making progress to the downside. Dips get bought faster. Bounces get sharper. Levels that used to break easily start holding. Bad news stops pushing price down. And that's when shorts begin to feel pressure, because the easy downside is gone. Pressure becomes covering. Covering becomes fuel. Fuel plus hedging plus thin liquidity can create a violent upside day. That's the transition people are talking about when they say Turnaround Tuesday. Now, the big mistake is treating that phrase like certainty. It isn't. It's a setup condition. If the flow flip doesn't appear, you don't force it. So how do we evaluate tomorrow without guessing? We use a simple, compressed checklist: 3 confirmations and 1 falsification test. This is your pro dashboard. Confirmation 1, hold support. Silver must stop breaking lower. Early weakness should fail. If the market keeps making lower lows easily, you do not have a turnaround. Confirmation 2, reclaim and hold. Silver must reclaim a key level and hold it. Not just spike above it, hold it. Reclaim without hold is bait. Confirmation 3, follow through. After reclaiming, the market must not immediately fade. It should hold gains and expand. If every rally is sold and fades quickly, the flow hasn't flipped. Now the falsification test, stated cleanly. If silver makes lower lows and rallies keep getting sold immediately, the turnaround thesis is dead for that session. Hold support, reclaim and hold, follow through. Lower lows plus sold rallies equals thesis dead. That's your entire framework. Now, you asked to define key level, so it's not vague. Here's the method, 1 sentence, clean. A key level is the last 2 to 5 sessions high or low, or a breakout point where price is held or rejected at least twice. That's it. You do not need 20 lines. You need 1 or 2 levels the market already proved it respects. Now, you also asked for where to check with exact tickers and minimal screens. Here it is. If you only watch 3 screens tomorrow, watch these: DXY for the dollar, US10Y for the 10-year yield, and silver, XAGUSD spot. And if you follow futures, COMEX SI. DXY, US10Y, and XAGUSD or SI. Those 3 screens are enough. Now let's explain why those screens matter, briefly, without turning this into a lecture. DXY matters because a surging dollar often pressures precious metals. It's not perfect correlation, but it's a headwind indicator. US10Y matters because rising yields tighten financial conditions and can weigh on metals. Again, not perfect, but it tells you if the macro wind is against you. XAGUSD and SI matter because that's the tape itself, the only thing that pays you. So tomorrow, here's how you use the dashboard. If DXY is ripping higher and US10Y is spiking, metals often face resistance. That doesn't make rallies impossible, but it raises the bar. It means you demand stronger reclaim and hold behavior before you believe in follow-through. If DXY is softening or stable and US10Y is calming, the headwinds are neutral or easing. In that environment, a reclaim and hold in silver has a better chance of expanding. And if the tape itself is refusing to break lower, reclaiming levels with urgency and holding gains, that's your flow flip. Now we need to tie this back to the $88 headline in the hardest conditional terms so nobody can accuse you of promising. Here is the clean version you can say out loud. $88 is only relevant if silver holds support early, reclaims and holds a key level, and then shows follow-through while DXY and US10Y are not intensifying against metals. Otherwise, ignore the number. That one sentence makes the claim bulletproof. Now let's talk about dealer hedging without over-technical language, because you requested a limiter and that matters for retention. You don't need options data. You don't need gamma charts. You need to watch behavior. If silver breaks out and the move accelerates instead of crawling and pullbacks remain shallow, that's often what hedging and short covering looks like on the tape. The reason is simple. Mechanical buying tends to be urgent and persistent. It doesn't negotiate. It doesn't wait for better entry. It buys because it must. So the tape becomes heavy upward. Dips become small and quick. That's the fingerprint. Now, to make this feel real, let me walk you through two mini scenarios, one real turnaround and one fake turnaround, so you can recognize the difference tomorrow without needing a guru. Scenario A, the real turnaround. Silver opens weak or choppy. The crowd expects continuation down, but the weakness doesn't accelerate. Support holds. Sellers push, but the market refuses to break. Then price reclaims a key level quickly, not slowly, quickly. Shorts feel pressure because the downside stopped paying. Covering starts. The breakout accelerates. Pullbacks are shallow. More buying hits as stops trigger and momentum joins. The tape runs. In that scenario, a big round number becomes a plausible magnet. Not guaranteed, but plausible, because the market is being forced higher and liquidity thins. Scenario B, the fake turnaround. Silver pops early. Everyone gets excited. Then it fails to reclaim and hold. Sellers hit the bounce. Price fades. It makes a lower high. Every rally becomes an exit. The market remains in sell the rally mode. The crowd gets chopped. The headline target stays a story. In that scenario, you do less, not more. You do not force a squeeze that isn't there. Now, this is where most people lose money. They confuse excitement with confirmation. Excitement is a feeling. Confirmation is behavior. Hold support, reclaim and hold, follow through. If those aren't present, your job is to stop arguing with the tape. Now, you also asked me to cut over poetic lines and use trader language. So here is the practical version of what volatility regimes do. Volatility regimes punish oversized positions. That's the whole sentence. It means if you size too big, normal pullbacks feel like disasters and you're forced out at the worst time. And in volatile silver, even a bullish day can include sharp pullbacks that shake people out. So the goal is not to call the number. The goal is to avoid being forced. Forced sellers create crashes. Forced buyers create squeezes. Your edge is to not become either of them. Now let's talk about the two behaviors that destroy traders in this exact setup: chasing and forcing. Chasing is when you see the move and you feel late, so you buy the worst price. Then the market pulls back to test. If you didn't plan for the pullback, you panic out. You become liquidity. Forcing is when you decide the move must happen, so you keep trading your belief even when the tape disagrees. You don't exit because you want to be right. That's how people blow up in silver. So let me say it plainly. A target is not a plan. A plan is conditions, entries, exits, and risk limits that you commit to before the market speeds up. Now, I want to give you one simple upgrade that increases performance immediately, especially for retail traders. Lower frequency decisions reduce errors. That means you decide in advance how many times you will act tomorrow. Once, twice, or every 5 minutes. If you act every time you feel something, you will eventually donate, especially in silver. So decide your decision frequency now while you're calm. That's how you stop emotion from controlling your mouse. Now let's build a practical decision tree you can literally write down in 30 seconds. If silver breaks support and cannot reclaim, I reduce risk or stand aside. If silver holds support, reclaims, and holds a key level and shows follow-through, I respect the upside scenario with controlled size. If silver whips with no reclaim and hold and no clean breakdown, I do less, not more. That's it. That's the tree. Now, to make key level usable, here's the one-line method again, because people forget. Key level equals last 2 to 5 sessions high or low, or a breakout point that held or rejected at least twice. If you can't explain your level in one sentence, it's decoration, not structure. Now, let's connect the macro screens to the silver tape in a way you can remember. DXY rising hard is a headwind. US10Y rising hard is tightening conditions. Silver can still move against headwinds, but the bar is higher. You demand stronger reclaim and hold and stronger follow-through before you believe it. If DXY is stable or softer and US10Y is stable or calming, headwinds are neutral. In that environment, silver's flow flip has more room to run. And remember, your primary signal is not a macro opinion. Your primary signal is the tape. Hold support, reclaim, and hold. follow through. Now let's address a common objection that smart viewers will have. They'll say, John, this still sounds like a story. Where is the hard proof that tomorrow is special? Here's the honest answer. We are not claiming the calendar is special. We are watching whether the structure is vulnerable. In markets like silver, the vulnerability can exist without a big public event. It can be internal, positioning, hedging, thin liquidity, and risk systems updating. That's why the only responsible approach is conditional. If the flow flips, you'll see it. If it doesn't, you don't invent it. That keeps you credible and keeps you safe. Now let's talk about what flow flip looks like when you're watching live. If silver is in a downtrend, it tends to punish longs. Rallies fade, support breaks, bounces are weak. When the flip happens, that behavior changes. Dips stop breaking, support holds. Reclaims happen faster. Rallies stop fading immediately. That's the moment where shorts start to feel late because the downside stopped paying. And in silver, when shorts feel late and liquidity is thin, the market can sprint. Now this is the part where people ask, so should I buy? No. I'm not telling you what to do. This is educational analysis, not financial advice. What I'm telling you is how to think, how to avoid chasing, how to avoid forcing, how to watch confirmations, how to know when the idea is wrong. Because the market doesn't pay you for excitement, it pays you for discipline. Now, one more nuance that increases trust. Even if the turnaround setup appears, the market may not go in a straight line. It may run, pull back, run again. It may shake out late buyers. It may trap early shorts. That is normal in a high volatility tape. So you don't judge the setup by whether every candle is green. You judge it by whether reclaimed levels hold and whether the tape keeps refusing to break lower. That's why reclaim and hold is the core. Now, let's bring the headline back and turn it into a final, clean statement you can use on camera without sounding like hype. Here it is. Tomorrow could be a turnaround only if the market shows a flow flip. Support holds, a key level is reclaimed and held, and follow-through appears, while DXY and US10Y are not intensifying against metals. If those conditions do not appear, ignore the $88 target. It's just a headline. That sentence is the upgrade. Now, as we move toward the end, I want to connect the dots in a way that's easy to remember. 3 screens, DXY, US10Y, XAGUSD, or SI. 3 confirmations. Hold support, reclaim, and hold. Follow through. 1 falsification test. Lower lows plus sold rallies equals thesis dead, and 1 behavior rule. Lower frequency decisions reduce errors. That is how you stay rational in a fast tape. Now I want you to engage with me because this channel grows when you participate, but more importantly, it forces you to be clear. 2 questions. First, do you believe tomorrow is more likely a real turnaround or a fake pop, and which key level are you using based on the last 2 to 5 sessions? Second, if you could watch only 1 screen tomorrow, DXY, US10Y, or XAGUSD and SI, which one would you watch and why? Ladies and gentlemen, my name is John A.G. If you found this valuable, please click the like button, subscribe, and hit the bell so you don't miss the next update. And remember, the number is not the plan. The conditions are the plan. Bye-bye for now.